Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're taking a look at TRX Gold.
And hey, if you find our talks useful, you know the drill. Please consider subscribing, liking, and dropping a comment underneath. It is Friday, January 30, 2026. And I have to be honest, looking at the market boards this morning, I feel like I need a double espresso just to keep up. We usually pride ourselves on finding these, slow, steady, get-rich-slowly stories. But what happened yesterday and this morning with TRX Gold, that's not slow. I mean, that's explosive.
It certainly wakes you up, doesn't it? It's one of those moments where the market, which, usually acts like this drowsy giant, suddenly just snaps to attention.
Yeah.
If you were watching the pre-market action yesterday, January 29th, you saw TRX Gold surge nearly 27% in pre-market.
Wow. In pre-market. That's not a normal Thursday morning for a mining stock.
Yeah.
Usually if a miner moves that much, it's because they just struck a mother lode or they're being bought out. But this feels different.
It is different. And what's so fascinating here is that this move is actually a delayed reaction. It's coming off the back of an initial, 11% gain right after they announced their earnings back on January 15th.
Right.
It feels like the algorithms, or maybe just the human investors, finally sat down, actually read the PDF and said, wait a minute, these numbers are real.
Which is funny because we always assume the market is this perfectly efficient machine that prices everything in instantly. But clearly it took 2 weeks for the crowd to really digest what was on the paper.
Yep.
So let's do what the market finally did. Let's look at the paper. Why the sudden rush? We've seen gold prices ticking up, sure. But a 27% jump implies something fundamental changed inside the machinery of the company. What's the trigger here?
The trigger is execution, pure and simple. We are looking at their Q1 2026 revenue, and the number you really need to circle is $25.1 million.
Okay, $25.1 million. In the grand scheme of the S&P 500, that's like a rounding error. But for a junior miner...
For a junior miner, it's a game changer. It is literally double what they did a year ago. In Q1 2025, revenue was $12.5 million.
Double.
They've delivered 100% year-over-year growth. When you double your revenue in 12 months, you stop being a speculative exploration play and you start becoming a growth business.
Doubling revenue is the holy grail.
Right.
But I have to play the skeptic here because I've been burned by resource stocks before.
Sure.
Usually when I see companies double revenue, especially in mining, I start worrying about the cost side. Did they burn through a mountain of cash to get that gold out of the ground? It's easy to sell dollar bills for 90 cents and call it revenue growth.
That is exactly the right instinct to have. Revenue is vanity, profit is sanity, right? But that brings us to the why behind this bullish sentiment. We have to talk about the macro backdrop and the micro execution at their Buckreef project. First, the macro. Gold is trading near $3,860 per ounce.
Which, let's just pause there, is an absolute historic anomaly. I remember when we were excited about $2,000 gold. We are nearly at $4,000. That's an inflationary signal if I've ever seen one.
The wind is definitely at their back. But, and this is the critical part of this deep dive, it's not just about the price of gold. It is about how much of that price they actually get to keep. We call this operational leverage.
Right. If gold goes up, but your cost of diesel, dynamite, and labor goes up by the same amount, you aren't actually making any more money. You're just spinning your wheels faster.
Precisely. But look at TRX. Their gross profit expanded to $14.2 million. That is a 57% margin.
57%. Hold on, that sounds more like a software company, not a company that crushes rocks.
It's incredibly high for a producer.
Yeah.
I mean, compare that to Q1 2025, where they had a 39% margin. That's an 1,800 basis point expansion.
Yeah.
They aren't just selling more gold, they're becoming drastically more efficient at doing it. Their adjusted EBITDA surged to $13.2 million, which is a 53% margin.
Okay, I want to linger on this operational leverage concept because it's a buzzword that gets thrown around on CNBC constantly, but rarely explained well. The mechanics matter here. How does a mine actually achieve that?
So think of it like an airline. The cost to fly a plane from New York to London is basically fixed fuel, pilot, landing fees. If the plane is half full, you lose money. If the plane is full, every ticket sold after the break-even point is pure profit.
Got it.
A mine is similar. TRX has the Buckreef Project. The cost to run that mine, the trucks, the processing plant, the staff, are relatively fixed, or at least controlled. TRX has guided that their cash cost is between $1,400 and $1,600 per ounce.
Okay, so sticking with the math. It costs them, let's say, $1,500 to pull an ounce of gold out of the dirt. That's the seat cost on the plane.
Right. Now, they turn around and sell that ounce to the market. In Q1, they sold about 6,500 ounces at an average realized price of 38.60.
That's the spread. Cost is $1,500. Sale price is nearly $3,900. That is roughly $2,300 of profit per ounce.
Exactly. And because those costs, the 1,500, stay relatively flat, every single extra dollar the gold price goes up flows straight to the bottom line. If gold goes to 4,000, their costs don't necessarily go up. That extra $140 is pure margin.
That's operational leverage.
That's operational leverage. They aren't just participating in the gold rally, they are leveraging it for maximum profit.
That explains the sentiment shift. I was looking at some of the quantitative analysis on the news flow around TRX. It's overwhelmingly positive, something like, 87% bullish sentiment in recent articles?
Well, it's hard to write a bearish article when a company doubles revenue and expands margins by nearly 20%. The numbers simply don't support a bear case on the current performance.
But here is where I get really skeptical. I've seen this movie before. A junior miner has a great quarter, the stock pops, everyone gets excited, and then 2 weeks later, they announce a massive equity raise. They dilute the shareholders to pay for a new truck, a new drill program, or a CEO bonus. Is TRX just going to take this stock surge and use it as an excuse to print more shares? Because that kills the rally every single time.
This is actually my favorite part of the story, and it's why we are doing a deep dive on them today. We need to talk about their financial health and what I call the anti-dilution strategy.
Anti-dilution. That is a phrase you almost never hear in the junior resource sector. It's usually dilute and survive.
Usually a junior miner is a cash furnace. They burn cash until they strike it rich or they go bust. TRX is attempting something different. They are running a self-funding model.
The self-funding model, okay.
Look at the balance sheet. Their current ratio has improved to 1.7. Their working capital, basically the cash they have on hand to run the business, is up to $15 million. It was only $5.7 million a year ago.
So they have actual liquidity. They aren't living paycheck to paycheck.
They have a cushion. But here's the kicker. They have a massive growth plan. They're planning a $30 million expansion of their processing plant.
$30 million. That's huge for a company this size.
It's a huge capital expenditure. It involves new ball mills, new leaching tanks, massive civil works. Or almost any other scenario, a company would say, great news, we are expanding. Now, please buy $30 million worth of new stock so we can pay for it.
And the stock price crashes because everyone's slice of the pie just got smaller. My 1% ownership becomes like 0.7% overnight.
Exactly. But TRX is saying, no, we are generating so much cash from operations. Remember that $4 million in operating cash flow in Q1 alone, that we are going to pay for this expansion internally.
So they're building the factory with the profits from the mine, not by asking me for more money. That feels like how a business is supposed to work, but it's so rare in mining.
CEO Stephen Maloney has been very clear about this. He says they are entering a new phase of growth. And for once, it seems like a CEO is actually delivering on guidance. They're proving they can fund their own growth. This protects existing shareholders. Your shares don't get watered down.
That creates a level of credibility that is really rare. If management says they can do it and then they actually pay for it with their own cash, that builds trust. And honestly, in the microcap space, trust is the most valuable asset you can have.
And trust commands a premium in the market, or at least it should. Which brings us to the valuation puzzle.
Right, the valuation. Because after a 27% pop, the natural instinct for any value investor is to think, I missed the boat, it's too expensive now, I'll wait for a dip.
Right.
But looking at the analyst notes, that might not be the right call.
It's definitely not the case if you look at the metrics. Even with the surge, the stock looks cheap. Let's look at price to sales, or PS. Currently, TRX is trading at a PS of about 3.8.
3.8. Okay. Is that high or low? I mean, NVIDIA trades at what, 30 times? But for a miner?
For a miner with these margins, the estimated fair value PS based on industry averages is around 9.6.
Whoa. So the market is pricing them at 3.8, but the industry standard is nearly triple that. Why the disconnect? Is the market just sleeping on this?
It's partly the junior discount. Small companies always trade at a discount because they're seen as riskier. But if you want a real aha moment, look at the discounted cash flow model, or DCF.
I love a good DCF shock, but usually these models are tweaked to look good. Lay it on me.
So a DCF model basically tries to calculate what all the future cash this mine will produce is worth today, discounted back for risk and time. Based on their current margins and the gold price environment, the DCF model suggests a fair value of CA $15.21 per share.
Wait, hold on. Let me just check the screen here. The stock is trading near, what, CA $1.30?
Yep, $1.30.
And the model says it should be $15.
$15.21, yep.
That implies. I can't even do that math in my head. That's over 1,000% upside. Okay, stop. That just sounds too good to be true. When I see 1,000% gap, I assume the model's broken, or it's assuming gold goes to $10,000 an ounce.
You're right to be skeptical. DCF models are highly sensitive. They assume gold stays high, production stays perfect, costs don't explode. But here's the thing. Even if the model is half right, even if it's 70% wrong,
Right.
the gap between $1.30 and $15 is so massive that there is an incredible margin of safety. It shows you how disconnected the share price has been from the actual cash the business is generating.
That is staggering.
Yeah.
It basically implies the market is pricing this company as if it's about to go bankrupt, while the financial statements say it's printing money. I see the analysts are starting to chase this too. I saw a note from H.C. Wainwright.
Yes. Heiko Isle from H.C. Wainwright. He raised his price target to $1.50. Now, that's not $15, but it's a move in the right direction. His rationale was exactly what we discussed. Expanded gross profits and margin gains from efficiency.
Yeah.
He sees the execution.
Okay, we are painting a really rosy picture here. Record revenue, massive margins, self-funding growth, and a valuation gap wide enough to drive a truck through. But this is our deep dive. We don't do puff pieces. We have to look at the downsides.
Of course.
If this is such a slam dunk, why isn't it trading at $5 already? What is the bear case? What can kill this thesis?
It's essential to look at the risks. This is not a risk-free savings account. It's a junior miner operating in East Africa. The first and biggest risk is the commodity price itself.
Gold. We are at all-time highs.
And the entire thesis, that 57% margin, that massive cash flow, it depends on gold staying near $38.60 an ounce.
And gold is volatile. We know this. If the Fed changes rates or if inflation cools down, gold could drop. If gold drops back down to, say, 3,200.
If gold drops to 32 or 3,400, their EBITDA drops significantly, probably by 30 or 40%. The profit engine slows way down. Now, the mitigation here is that their costs are so low, $1,400 an ounce, that they won't go bust. They will still be profitable at $2,000 gold. But that explosive growth narrative, that 1,000% upside potential, that evaporates.
So they are safe from bankruptcy, but the stock price would definitely retrace if gold slumps. It's a levered bet on gold.
Absolutely. But the second risk is one that keeps CEOs awake at night. Concentration. We talk about diversification in portfolios, but TRX is not diversified. They are a single asset company.
Buckreef is it. There's no backup mine in Nevada.
Buckreef is the whole show, and Buckreef is in Tanzania.
Which brings us to geopolitical risk.
Yes.
Tanzania has been, let's say, active in rewriting mining laws in the past.
They have. Things have improved under the current administration, but there is a specific uncertainty right now. TRX is in ongoing negotiations with the Tanzanian government regarding mining terms and, crucially, approvals for their tailings facility.
Tailings facility, let's clarify that. That's where the waste rock and sludge go after you take the gold out.
Yeah.
It's not the sexy part of mining, but it's essential. You can't mine if you can't flush the toilet.
Exactly. It's a bottleneck. If the government delays those permits or uses them as leverage to demand higher taxes or royalties, it could slow down everything. That $30 million expansion we love, it could get put on hold. You can't expand production if you don't have a permit to store the extra waste.
So if you are investing in TRX, you are betting on gold holding up, and you are betting on a bureaucratic negotiation in Tanzania going smoothly.
Correct. You have to be comfortable with that jurisdictional risk. It's why the stock trades at $1.30 and not $5. The market is discounting that political risk.
Okay, that makes sense. The discount isn't just ignorance, it's a risk premium. So let's look forward. We have the snapshot of today, Jan 30, 2026. What does the calendar look like? If I'm a listener holding this stock or thinking about buying, what are the dates or events I need to watch in the next 3 to 6 months?
There are a few key catalysts that will either prove the bull case or validate the bear case. First, keep an eye on late April 2026. That will be the Q2 earnings release.
The prove it quarter.
Exactly. Q1 was a record. Was it a fluke? Can they maintain that 57% margin? If they come out in Q2 with similar numbers, the market will have to accept this is the new normal.
Okay, late April. What else?
Government approvals. We expect news on the tailings facility permits sometime in Q1 or Q2 of this year. That will be a major de-risking event. If they get the green light, the stock likely responds positively because that uncertainty is removed. If there's a delay,
Watch out. And the expansion.
we want to see progress reports on that $30 million mill upgrade. They need to show they're breaking ground, ordering the ball mills, pouring concrete. And finally, just keep an eye on guidance. They targeted 25 to 30,000 ounces annually. Are they on track? If they start lowering that number, the thesis weakens.
So April, earnings, permits, and construction updates. That's the watch list.
That's the watch list.
All right, let's bring it home. We've covered the surge, the margins, the self-funding model, and the very real political risks. If you had to score this opportunity or summarize the final thesis, where do you land?
I'd give this a bullish score of 8.5 out of 10.
8.5. That is high praise from you. You usually hover around a 6.
It is high. But look at the facts. You have a junior producer acting like a major. They have 57% margins. They are self-funding their growth, which is incredibly rare in this sector. And we saw the institutional buying pressure yesterday. That volume tells you the big money is positioning. They see the value gap.
So what is the time frame? Is this a quick flip? Do I buy it today and sell it next Tuesday?
I don't think so. I view this as a 12 to 24-month hold. The expansion takes time to build. You want to be there when the new plant comes online and production jumps again. That's when the real repricing happens.
And for entry, since it just popped, 27%.
We saw a big spike, so don't chase it blindly. Traders will take profits. Ideal entry would be on pullbacks. If it dips below CA $1.20, that's a strong buy zone. In the medium term, I think a target of CA $1.50 to CA $2.50 is very realistic, especially if gold holds these levels.
CA $20.50 to CA $2.50. And considering we are sitting around $1.30, that is a healthy runway. It's a value play hidden inside a growth story.
That's a great way to put it.
You know, it leaves me with one final thought. We spend so much time looking at the tech giants, the AI stocks, the trillion-dollar companies. But here's a small company in Tanzania, quietly doubling its revenue and printing cash, basically unnoticed until yesterday. It makes you wonder, if a small player like TRX can print cash like this with gold at 3,800, what does that say about the massive inflation hedge trade we're all ignoring? Maybe TRX isn't just a stock pick. Maybe it's the canary in the coal mine for a much bigger shift in how we value hard assets versus paper promises.
That is the trillion-dollar question. If the small guys are making this much money, the macro shift is real.
Something to chew on over the weekend. Thanks for joining us on this deep dive.
Always a pleasure.